Hi everybody. So I wanted to do a quick video about kind of what a bear market would actually look like, because we have to distinguish whether we're in a bull market or whether we're in a bear market, and we're currently in a bull market. And the problem is that, you know, a lot of individuals are always very quick to think that the market is completely overdone, it's overcooked, and therefore they start shorting the market. And statistically, that's the wrong way to do things, because over time the markets will always climb. So I thought what I would do is do a video that kind of would highlight what it is that we would actually need to see in order to know that the market is shifting. And the first thing that I would have to kind of highlight here, so I'm using the NASDAQ, and I'm just going to increase the number of units. So let's just increase that so we could see a little bit here. If we go back, this is now on the NASDAQ, this is now the 2007 financial crisis. So what I would just draw your attention to is, first of all, we have high lows and high highs going into that. We then price pulls back, breaks the previous kind of low, and then attempts to go up and fails to get back up. It then comes down. And actually, this is really the key point. The second it breaks the kind of that previous low, you now have a confirmed downtrend. And that's where it actually picks up pace. And this is on a monthly time frame, so it's a very slow process. But that point, if you argue that kind of this candle here, January and December 2007, January 2008, if you argue that that was the last of the uptrend before it then shifted down, you could see that it took, let's say, 1, 2, 3, 4, 5, 6, 7, 8 months before it broke that low. And so it takes time. It's not something that happens overnight. And if we look at this, so the first thing I want to draw your attention to is we are in the last week of February, and I really want to see how this candle closes. If it closes as a very bearish or red candle with this very strong rejection, it's well overextended. So there's a couple of things that I should mention here. This has gone almost parabolic. The angle of the sort of price action here is kind of going almost straight up, which is completely unsustainable. Hear me again, it is unsustainable, cannot do that. So the market has to kind of extend, retrace, breathe out, breathe in. We've had a consolidation here, so we're still very much in a bull market, and we need to see what happens here. So this would be kind of the single, if it does close as a rejection candle, it would be the strongest rejection candle that I've actually seen in 10 years. If I look at all the points at which there's a bit of a rejection candle there, there's a little bit of an indecision candle, but this is really aggressive, and that would almost certainly imply, combined with the fact that it's overextended, combined with the fact that we're parabolic, taking that into account would imply almost certainly the price will do a bit of a correction or a retracement. So the language I'm using is basically that the trend is still intact, but price would actually come back down into these previous highs towards 8,000, or at least towards back into the moving averages. If the market is still bullish, it'll go sideways like it did here. But seeing as we've already had a consolidation here, I think we're just part of that normal trend. So if we were at the early seeds of a future bear market, this candle here would be the equivalent of this candle here. So in other words, here we are, price would then come back, fail to get back up again, and then come down and break the lows. So if, and I say if, that is the case. So I'm just going to draw on the screen, bear with me. So what I would need to see price do, obviously, is come back down into this area. Then it would have to attempt to go back up again. It could potentially hit the same height, or it could fail to get there, and then it would start to head lower. And really, it's only, the most important thing is that when it breaks this low, that's kind of, oops, that was really not attractive, when it breaks that low. So as soon as it breaks that low, then what happens is your most professional investors, traders, hedge funds, insurance companies would start to exit a lot of their positions at this point. Okay, because that's the point at which they now are convinced that the market is exploring fresh lows and not able to do fresh highs. So in other words, a lot of people would start shorting the market here potentially, but this is probably the safer approach. Then what actually happens is the market usually comes back up again and usually tests the same level from the underside. And it's really at this point that people who exited their positions here may consider, the ones who are able to, would consider actually shorting the market if they're in a position to do that. So in other words, the sellers start to pile up, and then this is usually where you get a bigger drop. So here you would get a much more aggressive drop, and this is usually the area that you hear about in the media. So then this is the point at which Amateurs have got in over here, convinced they've bought a lot of stocks, convinced the market's going to keep going. This is usually where they start to panic and try and get out of their positions. And so you get your amateurs exiting, your professionals are able to short the market or shorting the market, and the media becomes aware of it, becomes mainstream media. These kind of things will show up in the financial media, but this will really be the thing. That'll be it. And this will look pretty dire from a daily perspective. If we go and have a look at these levels on a daily perspective, you'll see that distance. But this is actually what we need to see. And the point of this video is to talk to you about how much has to happen before we get really to this point. Okay, so that's our first point we get to, and that'll be the second point where there's a rejection, and we might get a candle here. We might get a candle that's similar in shape to that over there, and then if it breaks, the loan follows through, we'll see that drop. And this is all on a monthly time frame, and so that period of time could take anywhere from 6 months to 18 months. So it really, really, really is a it takes a while to do that. So let's go and have a look at what the distances are from here down to here, perhaps on the daily time frame. So I'm going to go back to the 75 units and just go drop down to the daily here, and then kind of show you how far away those levels are. So really, if we kind of zoom out, this is the first level over here, and there's further levels down below that. Okay, so that is really the kind of distance we have to go, and so from a media perspective, it's going to look quite scary. But on a monthly scale, on a much longer term scale, it's not really that bad. In fact, I would, and this is so far it's just a technical guess, but I would think that the worst case scenario would probably be to just give back all the gains that we've had during Trump's presidency. So if I go and have a look, say, at the S&P, all right, and so this again is supposed to be a monthly, so let me just change that up to a monthly. This is where Trump came in. So this was when he became president, and this entire period, if we go have a look at this, this is all Obama. Okay, so this entire stretch here is Obama. This patch is Trump. This consolidation patch is also that, and this is him. So actually, a lot of this is thanks primarily to Obama, and this Trump's has not actually. Although he is at all-time highs, arguably the gain has been still less than during Obama's period. Okay, fine. But the other thing I would add on that note is that the market is always going to be getting to new all-time highs. So the president who's in charge at that time can always take the credit for it. But the market's always going to be climbing, and it's always going to have market crashes. We're going to have those. We will have bear markets, and the market's going to be reaching all-time highs. And when we have a market crash, the president's going to get the blame. And when we have new all-time highs, the president's going to get the credit for it. But actually, Trump's just claiming credit for what the market would be doing and will continue to do into the future long after he is gone. And the other thing is that he will absolutely, when we are due for a market crash, he's going to absolutely blame that if he gets voted out. And he's trying his best to corrupt, obviously, the election so that he doesn't get voted out. But if he does, and we do ultimately have a bear market, he's going to blame that on it. But the fact of the matter is, a bear market is coming in our future. It could be years away. It could be 18 months away. It is going to happen. We will always have them because it's actually a correction on a much larger basis. So I apologize, this is slightly longer than I wanted this video to be, but I think it's important. If we look at this on a quarterly basis, you can actually get a sense of where price could come back to, and I'm noting that quarterly bearish candle as well, so that would give you a sense of where we could come back to. And if you go back to a yearly basis, so it's really about getting perspective. You go back to a yearly basis, look at this. So actually you can see really where the market could even come back down to 2,500. Okay, so if we go then, and I'll just go ahead and just put a level in there, and then go back to the monthly to give you a sense of that distance. That's really it. So it's not that bad. And it's going to happen, whether Trump is in the office or not. Make no mistake that even if he's in office, we can still have a bear market. So it's just that, you know, he's a bullshit artist of note and a pathological liar. So he's often trying to take credit for stuff he doesn't do at all. Anyway, just thought I would discuss this with you. This is more of my market kind of hypothesis, but that is based off technical experience, and that is likely to happen. So we don't have to get religious about it. It's just something that happens. Okay, so thank you very much, and I'm curious on any thoughts you might have. Please chuck them into the comments box. Thanks.